We are live.
Good afternoon, everyone. Thank you. I thank ASSOCHAM team and Capital Market in particular to conduct this important webinar. We'll discuss today the impact of COVID-19 on economy and in particular the capital markets. ASSOCHAM is proactively engaging with the member government for their problems and relief they are seeking for. We are celebrating New Year in different parts of the country. Yesterday, we celebrated Vaisakhi, and today we have a New Year. My greetings to all the participants. Please keep a social distance while celebrating. At the same breath, I want to salute and congratulate army of people in front protecting us, doctors, paramedical staff, police, and other working in this tough environment and exposing to the possible risk of this virus. We are all facing unprecedented and difficult times. There is a risk of lives and livelihood because of coronavirus pandemic. Industry, trade, and commerce are under lockdown for last 21 days. And today our Honorable Prime Minister has extended it to May 3rd. He has announced more stricter compliances for the lockdown, but some relaxation for businesses also, with social distancing and other norms. Whatever needs to be done must be done. We are with the government for their efforts to contain this pandemic. To discuss this all, we have eminent panelists with us. We have Mr. Madan Sabnaves. He is a chief economist with Care Rating and author of 2,500 articles and 3 books. He is my colleague in the CDA committee of SEBI, and he is a member of various committees of SEBI. Then we have Mr. Ashok Haldia, a veteran. He was the longest serving secretary of Institute of Chartered Accountants of India, former managing director of Power Trading Finance Corporation. He is in the governing board of IMT, IFV, and is a regular contributor to National Economic Dailies. We have Subhash Agarwalji, chairman and managing director of SMC Group, the largest client surveying firm in the financial services, and a senior executive committee member of ASSOCHAM. We have Mr. Rishi Nathani. He's a business head with MCX. We have Mr. Naveen Mathur, director with Anand Rathi. We'll have opening comments from each of the panelists on COVID-19 and its impact on the economy, and in particular the capital market, and then we'll have a question answer session at the end of it. First to Mr. Madan, for your views on immediate and long-term impact of coronavirus on economy. Over to you, Mr. Madan.
Thanks a lot, Narendra, and good afternoon to everyone. I think what we all of us did expect that when the Prime Minister came on air today, that the lockdown is going to be extended, and that quite according to our expectations, I think this extension has taken place right up to May 3rd. But if you actually look back and say as to when exactly did it begin, it probably began on 22nd of March. So if I start calculating from 22nd March to May 3rd, we're actually talking of virtually 6 weeks of lockdown in the country. Now, I think this will seem to be the only cure for everyone, because global experiences was that social distancing was the only cure, and therefore a lockdown was a natural corollary, and that's exactly what the Indian government announced, and I think that's probably the most practical way to go about it. But once we had the lockdown announced, and I would probably say even a few days or a few weeks before the lockdown was officially announced, quite a number of activities had actually come to an end or was moving towards the end, like visits to a theater, visits to a movie hall, to the malls. I think that kind of a lockdown in a diluted manner had started maybe 2 weeks before officially there was a clampdown on all activity. Now, I think the moment the lockdown was announced, I think the first thing which occurred to us was that all of us went round looking for goods, and we found that most of the shops where we were doing our daily grocery purchases were able to supply for a few days. And as to what really happened, and we realized that while there were announcements made at the high level that essential goods were exempted from the lockdown, but there were practical issues which did come up. And I think these are the practical issues which I think the government has been trying to plug in to a very large extent. But given the fact that we have a federal structure, and when I say a federal structure, we have a number of states, and every state has their own interpretation of the rules which come from above. And if you go back to the state government, you go to the municipal level, you go to the panchayat level, everybody has their own interpretation. And therefore, we did see there was a lot of, I would say, disruptions which took place in the supply chains. And there was no longer the free flow of goods which was promised at the higher level. Now, in a very rudimentary manner, let me put across what really did happen. We spoke to a number of these FMCG companies which were producing goods. They said that, look, we're not able to produce goods because I don't have labor. Because the moment the lockdown was announced, we saw that a number of migrant laborers, that is people who were not having a regular salary, they were all told that their jobs were off, and therefore they needed to go back to their own towns and villages. So there was a major exodus which took place from some of the larger cities and towns. Now, once the labor moved out, there was a whole problem of saying that if the factory which is producing, say, edible oils required people to produce the oil, let's assume that they had the raw material with them, you suddenly realized that labor was not there. And in case you had labor and you were able to produce the goods, you didn't have to have people to carry the stock out of the godowns. If you managed to get people to carry the stocks out of the godowns, to put them onto the trucks, but the trucks were not functional because there were no drivers for the trucks. So this is in a very brief way, one can say that this was a kind of a supply chain distortion which happened in different industries at different points of time. And while today I can say that we can confidently say that around 25 to 40% of activity has actually gone on stream, but there are still problems which are there at various checkposts where trucks are being stopped. There's no free passage of goods. You need to give a lot of explanations as to why the goods are moving, whether the goods are really essential or not. So it has not yet been fully streamlined, but definitely given the situation from 24th of March till say today, I think there has been substantial improvement. And going ahead, I think we can be a bit sanguine that things are going to improve and the supply chains are going to improve. Now, what exactly has been the impact on the overall economic situation? Now, if you look at India's GDP growth, for example, we have a GDP of around 220 lakh crores. That is in nominal terms. And if I divide it by, say, 12, I would say that roughly speaking, we have something like 18 lakh crores of GDP, which is being produced every month. And in case I have a shutdown of 1 month, 1.5 months, which we're talking of, intuitively, we can say that 18 lakh crores plus 9 lakh crores, 27 lakh crores of GDP is going to be under jeopardy. Now, there is some part of GDP which is still taking place. Like if I look at agriculture, agricultural production is taking place and the growth in the Rabi is supposed to be fairly good. So therefore, I think agricultural production will continue. If you look at the financial services, I think all of us on the panel belong to the financial services, and all our jobs are actually carrying on, our business is carrying on, we're working from home. So financial services have been relatively insulated from this particular virus attack. If you look at the government sector, the government has come up with a certain package program of spending 1.7 lakh crores in the next 3 months. So that is a big positive, which means that there is a certain amount of GDP which is happening. There's a certain amount of GDP which is lost, and there's a certain amount of GDP which can be regained. So let's try and put this in a perspective. So if I say agriculture does well, financial services on the rise, certain industries like pharmaceuticals, FMCG will become normal maybe in the next 3 months or so. So that should not be a problem. Government spending will be fairly aggressive in the first quarter. But I think the larger question is that will the government go beyond the 3.5% fiscal deficit mark? Are they going to double it? Is there going to be more fiscal impetus provided in terms of higher spending? That's something which remains to be seen. If you look at the services sector, I would tend to believe that things like media, you look at entertainment, you look at tourism, you look at hotels. I think once you lose your GDP in a particular period of time, it's very unlikely that you can recoup this kind of loss. Okay, merely because I don't go to a restaurant for these 3 months doesn't mean I'm going to go 3 times more once things become normal. In fact, if you look at the aviation industry, Lots of us keep doing jet setting, going for various meetings. We keep going to Delhi, we keep going to Chennai. Now, the way in which our business is changed, the way we are able to operate from home, the way we are able to communicate, and the very fact that ASSOCHAM has been holding this particular seminar without calling us all to Delhi, actually intuitively tells us that we'll probably do business in a smarter manner, in a more economical manner. And it's quite possible that these kind of industries which have lost their value addition or their GDP are very unlikely to recoup it even after normalcy returns. Now, if you look at the manufacturing sector, today we have an issue of saying that will the government be in a position to spend on roads? Will they be in a position to set up more power plants? That's the private sector coming in. So I think this has been a recommendation made that the government should actually be pushing forth their capital expenditure in this particular quarter. Now, from what we have heard, the government has said very clearly that ministries are going to cut down on expenditures. They have certain norms which have been passed. They have said that only essential kind of expenditure will take place, more which are directed towards the poor and needy. Things like capex has been kept at the background. But even if we have to go in for capital expenditure today, so I'm talking of the overall investment situation, it's not very likely that anybody will go in for higher investment. We already have surplus capacity in industry. RBI's data shows that it's around 68, 69%. Typically, we require something like 78 to 80% before fresh capacity is put by the private sector. And today, even if I want to construct a road, where do I get the cement from? Where do I get the steel from? Where do I get the labor from? So I think these are the kind of challenges which are there for any economic activity today, that with the supply chains being disrupted, if I'm going to go ahead with any kind of production, I'm going to have a problem in terms of getting my inputs in order to make my output. So if you look at the rest of the industries, if you look at the consumer goods, for example, the intermediate goods, look at the basic goods, I think they're going to recover, but it's going to come with a major lag. And therefore, I think the first quarter of the year could be considered to be a kind of a washout for India. Now, it's very hard to actually put a number to it. And I think quite prudently, I think when the RBI governor was asked about whether they have any forecast for the year, they said that we really don't know how deep is going to be the impact of the virus. And I think that's very much clear, because we started off by saying that they should close down for 3 weeks. Now we're saying it's going to become 6 weeks. Now there could be further extensions taking place. So I think it's very difficult to take a kind of a guess about what could really be the growth implications. But still, in case you're going to force saying that you're an economist, you'll have to put some kind of a number. I would say that the best possible scenario for Q1, growth will not be more than 1.5 to 2%. And why also this 1.5 to 2%? Because the government is going to spend. Hopefully, the Rabi harvest actually translate and come into the mandis and really add to your to our GDP. And quite interestingly, if you look at the way in which GDP is calculated, they don't talk about sale; they talk about production. So as long as your satellite imaging shows that production has taken place, so the GDP will be very much there. So while farmers may have a problem in terms of reaching their crop, and I think here probably we'll have the panelists giving their own view about how the agricultural value chain is moving. But even in case it's a problem, my GDP will probably still be registered. So I think 1.5 to 2% is something kind of a growth rate which we can really see in the first quarter. And how about the rest of the year? I think for the rest of the year, things are going to be fairly challenging, because while even in case, let's say that in the month of May, the PM says that we can have a partial rollback of economic activity and things can move towards normalcy, it's going to be a very, very slow process, because I think the major part is how do I get back labor into my mainstream? Because today we have seen there's been large-scale migration of labor out from their place of work. But getting them back will also mean getting hold of your entire transportation system. Your transport network will have to be refurbished. They will have to be reworked on. They have to be made operational, which requires both road transport, rail transport, air transport. Everything will have to be operationalized, which to my mind can take something like 3 to 4 months before normalcy can really be achieved. Which means that even after the rollover, or rather the roll down of this shutdown takes place and things return to normal, it will take another 3 to 4 months before production activities get normalized. So there's going to be quite a bit of pain, and I think the first half of the year will be very, very tepid, I would say. While the first quarter is definitely a washout, assuming that in the month of, say, June or so, we sort of try to get back onto our feet. I think it'll only be by the end of September or so that we can talk of the normal economic processes working, like the Kharif harvest coming in, rural spending, the festival season, and so on and so forth. And we should also remember that this particular shutdown has meant a lot of hardship for labor, because I've spoken to a number of our clients, a number of our companies. People are using various options. There are layoffs taking place, even of organized labor. People are going in for salary cuts. You don't take a payment for 1 month, or you don't take it for 2 months, or there's a 10%, 5% salary cut, depending upon what your salary is. If you're earning more money, you have a 30% pay cut. Otherwise, it could be 5% or 10% or 15%. So different companies are adopting different models, which really means that companies are not in a position to pay their salaries. So people's ability to spend is also going to get affected once normalcy returns. And therefore, even the so-called consumption story, which normally tends to take off in the second half of the year, could get deferred by another year, I would think, because it all depends upon how these things really pan. Now, coming back to the corporates and coming back to what the government, what the RBI has been doing, I think very affirmative steps have been taken on all fronts. So if you go back to the first package of the finance minister, I think that was more of operational in nature, making sure that all the compliances which had to be statutorily done, you were given more time to do it. So the 3-month formula works, saying that what had to be done in March, you could do up to June. IBC, I think that was a big relief for the SMEs, where you say that, okay, you will not be taken to the IBC, we're increasing the threshold level, so therefore there's more tolerance being shown. Then the government came up with the second package almost immediately, and the focus there was to say that, okay, there are a number of people who are on the roads, a number of people don't have money, a number of people don't have food. So therefore, this entire policy of this package of 1.7 lakh crores was supposed to address their needs. And I think this entire concept of Jan Dhan account, an Aadhaar account, and also the mobile phone, I think that has helped a lot, because what we have heard at the ground level, a lot of transfer of money has already taken place. Of course, identification has always been a problem, but to the extent that the government has been able to do it, I think the JAM has helped to transfer the amount of money to the poorer people. In terms of the food grains which have to move, I think that's still a bit of a challenge, because that easy, but the government is doing its best. So I think this which we're talking about is something which will help to survival. It was commendable, I think. And let's look at what the RBI did. I think I'm hearing my echo right now. Okay. What the RBI did was to actually make sure that the interest rates moved downwards, and it was done in a very, very positive manner. A was to cut the CRR to make sure there's more funds in the market. You also cut the repo rate to 4.4%. You reduce the reverse repo rate to 4%, which means that earlier banks had surplus funds. They were putting it in the reverse repo. Now you make it unattractive for them. You sort of force them or nudge them to lend. I think the more important part from the point of view of the debt market was the targeted LTRO which came about. So I think that is a very great step of the RBI, because the moment you say that there's 1 lakh crores which is going to be given purely for the market, I think that's a big boost for the debt market. So what is the rule? Basically, be 1 lakh of target repo operations, 50,000 crores in primary market, 50,000 crores go into the secondary market. What this really means that when the bank gets 50,000 crores, they cannot really invest in government securities, which they were doing under the LTRO. Instead, you're forced to put it in the debt market. And what we have seen as a rating agency is that there have already been quite a few companies which are trying to raise funds in the bond market because they know there's going to be a buyer. And I think the NBFCs is one particular segment which is probably going to benefit from it. Now, the next thing which the RBI did was to give this moratorium, because I think as we spoke about economic activity coming to a halt, we're saying investment coming to a halt, people not there, production, the factories being closed down. This also means that my production processes have been affected. Now, when your production processes are affected, you don't have revenue. If you don't have revenue, you will not be able to service debt. And this is a kind of a real problem which is there. So what the RBI has actually done is at all levels, we've said that, okay, there's going to be a kind of extension given to you up to the month of June, so that the NPA levels do not really increase right now. And hopefully when the companies come back into action, they will be in a position to service debt. But here I have a slightly a different view here, because I think we have actually been deferring the problem. And I think one of the issues which could become a major problem for us is how do we actually get out of this tangle? Because it's one thing to say that all the people who have to service the debt, have to repay the debt, don't do it. You can do it over the next 3 months. But when economic activity comes to an end for 3 months, so it's at a very minimal level, hotels are not going to work, the airlines are not going to function. How will they will be in a position to service the debt on July 1st? So I think that is a big conundrum which is there for the entire system. And we should be prepared for the RBI probably extending the moratorium on a selective basis. Otherwise, I think the banking system is going to have a major challenge in front of them as to how do we actually get out of this entire tangle. So do I expect anything more from the government at this point of time? I really don't think so. I think tomorrow there could be some kind of an announcements about how certain sectors could be brought back into the mainline activity. But I don't think there will be any sector-specific kind of stops or any sector-specific benefits to be given by the RBI. Because I think there's been some talk, some kind of queries coming about whether the RBI is going to intervene and have a special kind of funding for NBFCs or for sectors under distress. I think that may be jumping the gun right now. I think to go back historically in the last 1 or 2 years, most of the packages which have been provided by the government are more on the supply side. Like the auto industry had some things on the BS4, the BS6. You probably make some kind of exemptions out there. You clear certain kind of rules which are there. But I don't think there's going to be any kind of additional monetary stimulus to be provided. Now, against all this situation, one thing which we can really look at is that the overall fiscal balances of both the central and the state governments are going to be under tremendous pressure this year. And I think there will be some kind of a fiscal holiday which has to be taken up. Because when I'm looking at the fiscal situation and I'm looking at the government's fiscal deficit target of 3.5%, I think the biggest problem for them is how do I garner revenue this year? Now, let's look at the lockdown situation. See, we always had this thumb rule which said that GST collections are going to be 1 lakh crores per month. Now, we had a 6 weeks of lockdown means most of the goods under which we have the GST coming in are not really going to be sold, which means that the government's revenue is going to get impacted substantially on account of your GST revenue loss. If I'm saying that the corporates are not going to do well, it automatically means that the corporate tax collections are going to come down. India has a lockdown, other countries have a lockdown. This also means that your inputs are going to get affected, customs collections are going to be down. Income tax collections are going to get affected if people have lost their jobs, they're getting lower salaries. Definitely there's going to be a problem on income tax collections. So I think the aggregate tax collections of 24 lakh crores or so, which we do it both at the center as well as the central level, I think that's going to get impacted substantially this year. And we can see major problems for the government in terms of balancing their budgets, even if I don't talk in terms of the additional expenditure which is being incurred by both the center and the states. To top it all, we have the disinvestment program, which was fairly aggressive at 2 lakh crores. It's very unlikely that you can even get something like 1 lakh crores in this particular market, because we should realize that when the equity market is down, disinvestment doesn't take place. Disinvestment takes place when the market does well. Otherwise, you may have one PSU buying into another, which is quite possible could happen this time too. But 2 lakh crores to my mind is a very large amount. So we're looking at a slippage of something like 1.5 to 2% of GDP on the central government side. In terms of the state governments, I have a feeling that there could be some kind of a leeway provided to them. The 3% or the 3.5% fiscal deficit number, which is binding on states, could be relaxed by another 0.5 to 1%. So overall, we can be looking at a slippage of something in the region of around 2.5 to 3% for all the government sector put together. So on the whole, I would tend to believe that this particular year will be a very, very challenging year for us. The economic numbers are not going to look good. But I think what's more important, which the PM also has emphasized, is human life. And I think if we're able to cut down the number of people who are affected by this virus and in terms of the number of deaths which take place, I think the effort may be very much worth it. But for overall industry, for the markets, I don't really see cheerful times. Maybe after the first half, in the second half, things may look better, but that would be only marginally better. And the real growth, or the real kind of takeoff, can be expected only from 21-22 onwards. 2021 will be very much subdued. Now, quite interestingly, just before I sign off, I would say that one of the UN reports had earlier said that India and China would be the two shining stars this year. They haven't given any kind of an explanation. This probably holds some kind of hope for us. Because today, even if you look at some of the projections made by ADB, they still look to be in the region of around 3 to 4%. So I think we were just about amble along, but there's going to be a lot of hardship for us. And I think lots of industries are going to be under pressure, especially those which are considered to be non-essential. Services are going to have major challenges. And I think the service sector will take even a longer time to recover, because I think all of us going in for holidays or going to watch movies, theater, I think all that is going to get is going to be very low key even during the second half of the year. Okay, I'll end out here. Thank you.
Thank you, Madanji. Now, Mr. Haldia, so I want your comments. What's your view of impact on impact of COVID-19 on employment? And lots of reports are there that people are laying off and closing their units. I want your views on NPA, IBC, and on already weak banking and financial system, especially banks and NBFC. What could be the impact? And some moratorium is been given for 3 months. Do you think that is enough? And what will be the impact of this moratorium on these financial units? Over to you, Mr. Haldia.
Thank you, Mr. Wadhwa, and thank you for inviting me. Mr. Sabnis has given an excellent overview of the economy, and let me take you through what really is happening, and to me, it's going to happen at the industry level, at the financial services sector level, and also in turn to your question as to what's going to happen on the employment level. This coronavirus is going on since in China. We have been hearing about what it is, an invisible, the ghost, since January. And I know for certain that everyone was aware of as to what it could possibly mean to China, what it possibly mean to others, to other countries' economy, including the developed and developing ones. And I know for certain that some of the multinational companies had asked their offices to keep their balance sheet liquid, to liquidate their investment wherever possible across the globe, and keep their balance sheet liquid. And this was also, and they also issued, I know for certain that some of the multinational issues advisories at the end of the middle of the January or toward the end of the January, that the foreign travel should not be undertaken unless it is absolutely necessary. So what I'm trying to say is that those who were aware of, those who thought they are forewarned about what's going to happen, they did try to prepare themselves as far as their balance sheet is concerned, as far as their strategy and operation is concerned. Because what is important at the level, both the financial sector and the non-financial sector, is that you need to keep your balance sheet liquid, more than what the RBI norms would normally provide for, what the financial services expert would tell that you can leverage, taking into account what the market opportunities are and what potentially you can take from the market. These are the new aggressive financial theories, no more sustainable in the time of uncertainties, where you do not face with the risk, but you are faced with the uncertainties. Today we have invisible, we do not know. Still, we are grappling with invisible. We do not know how it would manifest, how long it is going to last, and how it's going to impact all of us. Given that fact, let us look at the industrial level. Those who are already, the liquidity is stuck, they are far deeper into the liquidity problem. Those who are liquidity surplus, they are getting liquidity stuck. And RBI has given certain SOPs, certain measures, which Mr. Madhanus has explained. To me, possibly, those are not enough, for the reason that as and when today you need to sustain your company and you need liquidity to sustain. And as soon as we are over with the lockdown or maybe the coronavirus, then we need to bring back the industry and the operations. Now, for that, you need further liquidity. Possibly, the system has a liquidity, but the banks are not willing to lend. And to believe me, banks would not be willing to lend. Whatsoever be the government pressures, whatsoever be the RBI schemes, LTR, or various others they would bring in, banks today are far more prudent than what they used to be in the yesteryears or maybe in the year 2008. I will draw the analogy with the financial crisis of 2008 and where the industry sector today is. The chancellor in the UK came out such a heavy package, economic package for the industry, and that also meant some sort of a support to the financials, to the banks and the financial institution in case they provide lending to the large and the small enterprises. They are not coming forward, and the chancellors, I heard him saying that he's not surprised that they are not coming forward and provide that support. The US government has come out with the economic package, and I would be surprised if the banks would be, unless they are pushed by the government, they would be willing to provide that support. We had other day the SBI chairman telling us to the world at large that unless the government provides us the guarantee, it will be difficult for us to lend. Now, if that is the scenario, what are we trying to do? Normally, in such a scenario, any lender would be expected to behave prudently. You need to see the project, the company's viability, the future viability, its ability to sustain now, and its ability to continue to remain viable in future. Now, instead of that, the banks are possibly drawing comfort from the government guarantee. And I don't think the government would come forward and provide guarantee to the extent of the funding that the small and medium-sized enterprises in aggregate and the infrastructure projects individually or in aggregate would require. So to me, possibly that those measures are not enough. We possibly need to have a far matured banking sector and the financial institution sector who know how to lend and what is the prudent lending it is all about. Because if you are lending without being prudent, then you are throwing good money after the bad money, and possibly we would land to the situation what we were few years ago in terms of the huge amount of NPAs, because what we said was the creation of period between 2008 to 2014. Now remember also that this time the crisis is different than the crisis of 1991, 1992 or 2001, or for that matter financial crisis of 2008. Here we are faced with a financial crisis as well as the business crisis. Now, if you alone have if you have business crisis alone and the financial crisis is not there, the lenders are there to provide you the money and you can overcome your business crisis. But here you have both business crisis and the financial crisis, and possibly therefore you are in a deeper problem. And to me, the incidence of sickness in the companies and of the stress into the companies, large and the small and medium enterprises, should be far more than what we are expecting today or what we are made to believe today. And that's why the industry have to be far more cautious, far more careful in terms of they need to look into different ways of supporting themselves, different ways of gaining viabilities through the merger amalgamations, to the collaboration and so on and so forth. To me, that would be happening. A new business order would emerge post coronavirus, and we should be and to me that would be a positive sign of the coronavirus problem. Now, what way the RBI should address this problem? We know the companies that do not have ability to pay. Some of them may be viable today. Some of them may not be viable. Some of them may be viable tomorrow. They may be viable today, may not be viable tomorrow. But what that RBI can do, RBI should come up with a package of relieving them of their current debt liabilities, rescheduling it, phasing it over a longer period of time, and at a concessional rate, at a rate at which their future viability can afford. And secondly, in order to support their future operations and the cash losses and the future cash flow requirements, they need to have the lenders who can provide support. Unfortunately, we have the banks and financial institutions who are friends of fair weather. Normally, the banks are expected to stand with you when you are in crisis. But what happens here, and maybe in many parts of the world, particularly developing and underdeveloped, that at a slightest moment of crisis, the banks would be first to run away and putting the company into difficult situations. So possibly these are going to be the bigger challenges that we should be expected to face. Unlike financial crisis of 2008, this crisis is not amenable to the fiscal or monetary policy. Fiscal or monetary policy alone may not help. You need to provide logistics support. You need to provide infrastructure support. You need to create entire ecosystems to make the entire economy running, walking and running. That is possibly is the challenge, and to me that challenge Meeting that challenge over a reasonable period of time, 6 months, 12 months, or be more than 1.5 years, would be a big challenge. We are seeing already in the banking and financial sector. To me, there would be upsurge in the case of NPAs. We should see new wave of NPAs, and if those NPAs are trying to be, I would say, massaged through the artificial means of government policies or regulatory forbearance, we are shifting the problem. We are not solving the problem. I believe the RBI and everybody should be careful in terms of handling the NPAs that might arise from the corporate sector. What I would believe in terms of moratorium, I would have thought that everybody knows that what is the dimensions of this coronavirus problem, and possibly everybody knew today, 3 months ago, and 6 months ago, that this problem is uncertain for a longer period of time. I would have thought that the RBI would have come up with certain dispensation where they would not have linked it to 3 months, 6 months, their various compliances, relaxation to 3 months, 2 months, 6 months. A reasonable case could have been, as possibly attempted in the UK, is that they would have said that when we received the health advisory that the coronavirus is manageable, the condition is manageable, from that day to 6 months, this moratorium is given. Now, what we are doing to this moratorium, we do not know, because if you talk to anybody, they would say they are not getting anything. It's better to pay rather than they avail the moratorium. The second thing is that where is the moratorium for the non-banking financial sector? What are we going to do for the non-banking financial sector? We have seen 2 major non-banking finance companies collapsing. Now, what happens to the others? The 25 to 35% of the NBFCs and the NBFCs investment is in jeopardized, and there has to be some mechanism. We need to think in terms of some mechanism, something like what has been done for the Yes Bank. I'm not saying that is something desirable or that should be done in perpetuity, but abnormal time requires an abnormal solutions. To me, possibly that could be the situations. Now you asked into something different question. Maybe on these questions of the industry conditions, maybe I'll take up some more questions during interactions. But now you asked me about the question of what happens to the manpower. It's a difficult situation, pathetic, sympathetic. It's a social and economic problem. The other day, I was part of a roundtable of an industry, and they had a view that unless you support the industry would compel, and it would not be any position to support the employees. So the employees should be asked to go away. What I believe is that we need to adopt a balanced approach. What is required? It's a huge problem. 50-60 million people. Some of them migrants, some of them construction worker, regular, informal sector. This is the lockdown period figure. Now, after the lockdown, this might increase further. Now, possibly, I would have thought that there would have been some different balancing of what the employees would need and what the organization's economic imperatives would be, and that is the best policy that any industry should aspire for. I would believe communication with the manpower and also working out some settlement package. Or I'm not saying settlement is something where you argue for your position, but some conciliation package where employees agree to some sacrifice and the employer continues to bear with that dispensations. Now, I'm sure there are going to number of dispute in these directions. I would believe an industry association, we should be recommended to the government that it should put in place a very simplified, straight, a mechanism whereby dispute arising between employer and the employees are effectively, independently, and comprehensively settled in a time-bound period. Mr. Wadhwa, I just take another 2 minutes to address to another issue, is the force majeure. What is going to happen force majeure? Is going to be another pandemic for the industry. Now, every contract would be reviewed. Every contract would be reviewed for performance, and every contract would be reviewed for force majeure. Now, how are we going to tackle this? The current law, we have seen the DISCOMs behaving the way they are, and still I'm sure, despite the Ministry of Powers dictates or advisory, they would mend themselves. But that's a big problem that the industry would face, that force measures in every commercial contract. Normally, the contract never visualized that there could be a situation like this. And lastly, we have an IBC mechanism, insolvency and bankruptcy. Mr. Subnivis talked about, the government dispensation, but look, the current dispensation never forced you to go to IBC. It's still on your option. If as a prudent banker you take, that a problem now is an external to the company. They should not force the company to IBC. So IBC doesn't, in that sense, the dispensation doesn't help. What is required is that a mechanism outside the IBC which is able to facilitate the industry recovery on a viable and a sustainable basis. Thank you very much, and I'm willing to take more questions during interactions. Thank you.
Advaji, you're not audible.
Okay.
Advaji, can you unmute your microphone? You're not audible.
You are asking me?
No, Mr. Wadhwa.
Hey, Varmaji, you're audible.
Okay.
Actually, nobody listened what you said.
Yeah. None of us could listen to what you said.
No, Varmaji was supposed to proceed further.
Yeah, thank you, Haldia ji. You were talking about NPAs and IBC, the situation. MSME are the biggest employer in our country, and they are facing they are bleeding in this situation. So how can we expect from them to keep on paying the salaries and all? What is your view on that? And one more thing, I was part of the webinar in morning. People were suggesting that whatever losses industry incur during this year, as you were associated with the Institute of Chartered Accountant, my question to you is, can these losses be amortized? Can we approach ICI or MCA for that?
On the first question is that the MSME, that if they are not sustainable, despite the government support, then possibly their continuance itself should be questionable. What I'm saying is the layoff is not the only answer. There is a whole world lies between the continued employment and the layoff. And that possibility any SME should explore. What is important in these times is the trust between the employer and the employee, that continuity of the trust. As Mr. Subnivis said, that this is a problem, is a temporary 3 months, 6 months, 1 year. Now, what happens is that this employer-employee relationship is the relationship, and maybe for that matter, any stakeholder. And when I'm saying employee, it means every stakeholder. I think if that trust is regained, then possibly that solution can be worked out. Now, as far as the losses are concerned, first is that our accounting standards are based on the principles of the accounts of the financial statement reflecting the economic reality. If the economic reality is what it is, then the financial statement should also reflect. There used to be an accounting standards on accounting in the hyperinflation economy in good old days, when the South American countries used to have 300-400% of the inflation rate. There are no such accounting standards at that point of time. But to me, that's not going to help either. For example, because now you have a quarterly statements, sorry, quarterly results you also need to announce. Now, if you do something in the March ending accounts, then you have the June quarter and then you have a September quarter. You do not know how long this problem is going to last. So it's better, today everyone is better informed about the coronavirus and its impact. What possibly they can do is they can provide for it, and in their financial statement they clearly indicate as to what is that portion of this loss which is because of the coronavirus impact. And believe me, not only the RBI, I was a part of a global seminar yesterday. Not only the RBI nor any central bank in anywhere in the world, that's my common sense understanding, would allow you to take advantage of any loss which is because of factors other than the non-coronavirus. So what I'm saying is that there is no accounting standard as such which would allow you to amortize these losses over a period of time. But to me, as an accountant, pure accountant, it is not harmful if you provide for it, because today everybody knows it. Tomorrow, when these losses are deferred and they show impact on a balance sheet, possibly people will not be able to appreciate why these losses, why this impact, and how this impact. So it's better to provide right today. Thank you.
Subhashi, I'll bring you here. You are having such a large client base doing clearing services also. What is your observation? What is your comment on COVID-19 and its impact on capital market? They say the markets are driven by two emotions, fear and greed, and fear is everywhere. How's your client base behaving?
Good evening, everyone. First of all, I would like to congratulate ASSOCHAM to having this webinar. And your question is how client is feeling. Actually, in share market, the trading is taking place. People are sitting idle, so they prefer do something. And those who are having interest in share market, they are doing trading. But broking, where online player is there, they are not finding very big difficulty. But those who are smaller brokers, they are finding difficulty because they are not so well equipped online or IT wise. So they are in the habit of sending employees in the office, and manually they are doing so many works. The 100% work is not online and on IT based. So they are facing certain difficulties. So they are interested that stock exchange should be closed. And whereas Zerodha and Upstocks and the SDFC Scottish, ICICI Scottish and other online brokerage, even us, those who are competent enough to do online, they are feeling better. Moreover, it's a tough time for everyone. There is no doubt in it. Because the corona lockdown is now first 21 days, it has been extended up to 3rd May, and you never know, it can be extended for any period. Even if they allow for working, still cases can be increased, and again they have to lock down, because up to and until the vaccination is not invented, proper medical treatment is not there, it can happen. So I can safely assume that at least 6 months to 12 months this problem should be there. Even if they open it, they have to close later, because when cases will increase, and it's a worldwide problem, everybody is facing this problem. UK, Germany, France, they have declared 15% financial package for their country, of 15% of their GDP. So if you work out the loss of India per day, it is expected it is 32,000 crore per day. So all packages is working out how much the economy is losing per day. And so considering this, I think government should come out a package, though they have come out a package for food security and daily wage laborers around 1,70,000 crore, and RBI has provided a liquidity of 3,70,000 crore. But the package needed in the country is much more. It should be around 8 to 12 lakh crore at least. That should be the minimum, because I think Madan Sabnavis, he has explained very well sector wise that how much loss economy is suffering various sector wise. Civil aviation, airlines, domestic as well as international flights are closed. Their fixed cost is there, their lease cost is there, so they are suffering a lot. Hotels, the restaurants, almost they are closed. Very few are operating, and very few home takeaways like that. So construction activities, real estate activities, factories, manufacturing, all sectors, even essential items are open, but they are not in a position to deliver to their potential, because if they are require certain stocks, if they have stocks in hand, they are able to supply it. Like pharma, they are importing a lot of chemicals from China and other various part of the countries. So to make the regular supply, they need manufacturing of the medicines and all other chemicals. So it's a tough time, and World Bank has given a financial package of $1 billion. ADB has given $2.2 billion package. Even on 28th March, PM had declared PM Care Fund, and various industries are contributing to that also. And government is supporting in many ways. They have supported like manufacturing package for pharma, package for electronics manufacturing, and we are expecting a big package from the SME and all other sectors which is needed. So we were talking about moratorium of 3 months. It is very very less, and NBFC needs a big package of moratorium as well as liquidity, and various sectors needed various type of expectations from the government. GST can be reduced and can be done half to revive the demand if some normal conditions prevails in the economy. So you have seen the Sensex dropped more than 4,000 on 23rd March recently. Our Sensex was 42,000 in December, and now it is 30,000. Big fall, more than 30%. So times are not good, and all sectors, all economy is feeling heat of this corona. And I think beside that also there is a great opportunity, because Japan has given a package of $990 billion to those who take out their manufacturing or association with China. So so it is a great opportunity by India to invite all those who want to leave China. So make in India can be successful. I think it's a tough time, and we have to face boldly, and we should be with the government in making economy revival. So Ashok Haldia ji also explained so many things in a very nice way, besides Madan Sabnavis, and I think more speakers are here. Thank you very much for listening me.
Thank you, Subhash ji. Thank you, Subhash ji. Now to Rishi ji. Rishi ji, you are from a financial infrastructure. You are heading the biggest exchange on commodities, MCX. volatility we have seen over the years, but this kind of volatility last 2 months, the commodities are swinging in the range of 30 to 40%. Crude dropped 30% and again went, there was an upwards swing also to the tune of 15%. So how you are tackling this kind of volatility, and what do you see? The underlying markets are not working properly. Where do you see the futures, commodities futures market in this coronavirus?
Thank you, Madhurji. First of all, I'd like to thank ASSOCHAM for giving us an opportunity to get together like this and share our views. And for all the viewers who've so patiently been listening to us, and for all the panelists who are here, it's a great learning experience from all of you. I'd like to say that this coronavirus is as big a black swan event as could have been in our lifetimes. I don't think in our lifetimes we've seen such a big black swan event. And we've seen, as earlier speakers have said, the various crises in the past, but they have been financial crisis or a geopolitical crisis. This time it is a human crisis, which is turning into a financial crisis. And my understanding is it will change the way we think, the way we live, the way we react to everything, the way we see the world around us. So it is a human behavior altering crisis, which I think, so it is far more impactful than mere economics. Having said that, the impact this is having or could have on our capital markets and our economy in general. Well, first of all, I'd like to congratulate our government for handling this crisis in the best way possible till now, because frankly, I don't think they could have handled it better. There's always scope for improvement. Everyone would say you could have done this, you could have done that, but running a country of almost 1.35 billion people and managing all of that, we've done a great job. And while this lockdown will have an impact and is having an impact economically on all of us, I think it is for the greater good. So we'll have to bear it with a pinch of salt. Now, for our economy, short term, we are all cognizant of the fact that there has been economic losses because of this shutdown and the lockdown. But in the long term, I believe that this coronavirus will restructure global manufacturing and will restructure global economics. And India will have a larger part to play as from what it did earlier. So I think a lot of more manufacturing will come into India, a lot of more trade and commerce will flow through India. So in that sense, even from our commodities perspective, I think India has a very great mid to long term future. When I say mid to long term, let me quantify that maybe financial year 2021 would not be all that great, maybe till September. See, because another thing is whenever a crisis happens, we come to know after the crisis happens, and then everyone gets together to try to get out of the crisis. So it's quantifiable. Right now, we are in the middle of the crisis, we're living it, and it's not quantifiable because we don't know how it will play out. We don't know how far it will spread globally, this illness, how when the cure will be out, when the vaccine will be out. So we are still in the middle of the crisis. So it's very difficult to say whether it'll be over in 3 months or 6 months or 1 month. I don't know. But what I do know is that maybe from next fiscal, as Madan said also, India will pick up very well in terms of economic activity. And in the longer term, you'll see much more global giants setting up manufacturing units here, a lot of trade and commerce flowing through here. So I believe from the commodities perspective also and from the economics perspective, a very bright future for India in the mid to long term. Another thing is that with this crisis, there will be a lot of flow of there will be increased stress on self-reliance, and because of that, every country will try to be more self-reliant. In that sense, India will also try to be more self-reliant on various aspects of the economy. And again, self-reliance, as we talked about, starts with Make in India. But as an MCH, we've been saying it's not only Make in India, but it's also trade in India and price in India. So that is the complete cycle of the self-reliance, which we hopefully will be seeing going forward. Another thing is that this crisis will force us to go back to basics, in my understanding. And because of that, we'll see a drop in discretionary expenditure and a focus on agriculture, on manufacturing, on basic needs, on infrastructure, on medical infrastructure, on physical infrastructure, healthcare, education, etc. Because of that, there will be some expenditure on that side. And especially on the agri front, we will need to bolster our agri economy, and the commodity exchanges will play a very important role in the agri economy. In recently, the government also allowed certain notified warehouses as mandis in this crisis. Going forward, I believe that warehousing infrastructure of exchanges could also be used to help aggregate farmer produce and effectively find proper pricing on the exchange platform, and thereafter its sale, benefiting both the consumer in terms of fair pricing and the farmer in terms of a good price for his produce. So a lot of wastages and a lot of inefficiencies of the existing structure will be removed because of using the exchange platform for agricultural produce storage and sale. Another thing is most of the contracts on the exchanges are deliverable, as we are seeing now in the metals, etc. also. So we were talking about the stress in manufacturing and in the MSMEs, SMEs, etc. Now, here there will be a lot of role again for the exchanges to play, because people can give and take delivery, store their goods on the exchange platforms in the base metals, the precious metals, etc. And the exchanges also act as a platform for short-term financing. So whether it's agricultural produce in the harvest, people can deposit it on the exchange, people can do cash carry, and then when the actual consumption takes place, it can keep going out of the warehouse. Similarly, if there is a dearth of liquidity in the system through the banking channels, etc., or on a OTC deal, maybe people may not want to trust each other, then the exchange platform is there where you can deposit your goods, sell them, and be assured that you'll get your payment subject to your goods being of the exchange approved quality. And the buyer also doesn't have to worry about the quality of goods, the quantum, etc. So I believe that the commodity exchanges will have a very important role to play going forward. The capital markets in general will have a more important role going forward, because more companies will need access to capital, and we might see on the equity side also companies raising capital through equity and debt. But in the commodities market, I see that post this lockdown is over, we will see there'll be a flurry of activity which has been pent up, but it'll be more towards the basic infrastructure needs, basic manufacturing, basic agriculture needs, which the exchanges are there to help and provide services for.
Rishiji, my question to you, since many mandis are, and most of the mandis are closed, how you are tackling this price pooling and how you are settling the prices? Although there was a circular from exchanges, and don't you think this is a time when we should look for abolition of APMC Act and come to the electronic mode, like integrate ENAM and all?
Yeah, so the two questions you've asked. So first of all, I'll answer the second part, is that already the government, as I said, has notified that certain notified warehouses can be used as mandis, etc. And this ENAM and organized warehousing and electronic trading will take off more and more because it is more efficient. It removes all the inefficiencies of storage, of price opacity, etc. So I am sure that the usage of the exchange infrastructure and the non-exchange warehousing infrastructure also will be much more taken up by the government and by various government agencies as well as private sector, and there'll be more and more people accessing the exchanges. In terms of volatility also, you had raised a point. So exchanges are there for people to hedge, and had they hedged their positions many manufacturing organizations would not have seen this downturn. Now the exchange has a very robust risk management system, surveillance system. That's why we're able to cope with this. Regarding spot bowling prices, like you said, that there is the spot markets, the mandis are closed, but there is a laid down procedure which we are following, basis which we are arriving at the pricing.
Thank you, Rishi. Now, Naveen now it's your turn. Say you represent a company which has a large client base, and you look after commodities and currencies. What is your view on impact of coronavirus and COVID-19 on our markets, and how you are tackling this volatility?
Thank you very much. First of all, Narendra ji, for asking and inviting us to be part of this particular webinar. I would like to also thank SOCHAM particularly for organizing such a seminar in these critical times. People need to be known what's happening. They need to be understanding what they need to do in the capital markets. Just to give you 5 minutes of the discussion from my side, I just add up to what Mr. Madan Sabnivas said in his opening remarks and added up to what Mr. Ashok Haldia said in his remarks in the initial discussions. Just to give a perspective, we are definitely in extraordinary, uncertain times. I think we must appreciate the efforts of the government, both the central and the state governments, of whatever they have done for effective handling of this crisis as of now. And I'm saying basis kind of the health infrastructure India has and the population where we live in. So I think commendable job by the governments across the country to manage the situation in spite of being what we are seeing, hardcore lockdown, economic. The people are talking about the life and the livelihood question. Having said that, the perspective from the February month till date, there has been a downfall in all the major stock markets across the globe. The China has fallen by around 8%. I'll give you a certain perspective in terms of numbers. The Nasdaq has fallen by around 11.6%. The Dow Jones, Japan, the Euro, all these markets have fallen by around 17 to 20%. But if you see the BSE Sensex, we have fallen at around 23%. So I think a lot to be done with respect to the capital markets to revive the sentiments and to revive the kind of things which needs to be put in perspective. What the governments have done across world and particularly India, the Indian government has done approximately $26.4 billion worth of money being or the amount which has been allocated for kind of a relief package, which is 0.8% of our total GDP. Versus if you see the developed world has given approximately $12 trillion, around $90 trillion worth of the global economy, and the governments have spent across the globe around $12 trillion. I think the government is in the right direction. We will see definitely kind of a bright ray of hope coming out of this particular lockdown too. There are certain things which has happened in the recent past, and particularly the interest has been too much on the crude oil. The way the markets have behaved, the markets are down to around $20–25 level, and they're back to around $30 levels right now. The WTI is trading at around 26, and the Brent is around $32–33. So I think the biggest burnt of this particular crisis in the pandemic is largely to the commodities, which are directly proportionate related or proportionally related to the economy. The World Bank has put down in terms of the global growth, and the numbers which people are talking about is approximately 1% for the global growth against around 2 or 3%, 3–3.5%, which we used to clock in the normal times. So I think India and the advanced world or the global economy is not different these days. What Mr. Madan Sabnivas said, the initial remarks itself is that we might be touching a GDP figure, a growth of a GDP at around 2% or 1.5–2% for this particular year. Having said that, I think these are the times where people need to build confidence. I think it's not the time to run away from the markets. Yes, there has been a volatility, and therefore with this particular volatility, people need to be a little cautious. We need to wait and watch. We need to have a right strategy to put in place. And I think what Rishi said is absolutely right. From the commodity perspective, people who are producers, consumers, or somewhere or the other, they have the physical market exposures to the commodities. The right time to get into these exchanges for the price risk management, to do hedging, etc., which we will be looking forward for umpteen years. Means the day when the exchanges started, the first question was that the corporates or the people who have the physical exposure should come onto the markets. And I think in these kind of volatile markets, it's a best strategy to hedge your positions if you can. The second thing which you have asked us or asked me is to how we are coping up. Yes, as a broking or as an intermediary, tough times, clients have lot many questions. We have lot many questions to be answered. But I think what has changed over the course of these 1 month or 3 weeks or 4 weeks is that from the offline model, lot many people have moved on to the online model. It's been from the couple of years, last 3 or 4 years, people have started looking forward from the offline to online. So I think this particular episode of crisis would also give the kind of a new dimension to how the broking happens, and people would slowly realize that that online the model would also be something to be looked into, apart from what you are looking forward to as an offline model. Having said that, this crisis, Narendra, is pretty different. Every speaker has said it, including Madan and Shri Rishi, even Ashokji, that this crisis is different from the rest of the crisis which we have seen, maybe 2001, maybe 2008. I think what people are talking about, it's worse than the Great Depression of 1929 or 1930, because it is not just the Wall Street or the financial markets which are impacted. It is a lot to do with the main street. Although the word street remains common between the both crisis, the Wall Street or the financial crisis of 2008, there the spillover effect was largely from the financial markets to the real economy. And we had tools, the Fed had tools, the central government and the governments across the globe, and the Federal Reserve or the central banks itself have the tools to manage that crisis, because that was a financial crisis, the balance sheet or the debt crisis. The situation is different today. It is the Main Street crisis. People are skeptical. What Madan said is absolutely right. People would have a less disposable incomes. So I think those disposable incomes which they used to spend lavishly maybe a month before, and the kind of scenario we are sitting in today would be a little difficult to look into. So I think there would be very cautious approach once we are back to kind of a normalcy. And as per my belief and understanding, I think this particular year would be a kind of a damp year in terms of whatever we are thinking about in terms of economy and growth, etc. But I think 2021 would be a little better one. We need to stay invested. We need to be there in the markets, believe in the markets, and be there. I think that's something which I want to convey. So don't lose your heart, in spite that you have lost big amount of money. If you are invested in financial markets, don't lose your heart. Right time to stay put in the markets. India is doing great, basis whatever population and the infrastructure, the health and the infrastructure we have. I think still a long way to go. So whatever we are doing, we are on the right track. I think just keep the patience and be there in the markets. Just be there. Don't panic as of now. Thank you.
Thank you. It was a great discussion, panel discussion today. Big thanks to our panelists, Mr. Madan, Ashok Haldiaji, and Naveenji. Tomorrow we are looking for a detailed guidance from government, and we hope that they'll consider lives and livelihoods together. Now, and there is a saying that it again is an event that shall pass on. I'll give it to Mr. Rajoraji for a formal vote of thanks. Rajora ji. Rajora ji, are you there? And big thanks to our participants of this webinar.
So do you want to do question answer session?
So we have a time till 6 o'clock, so we have to conclude.
Okay.
Rajora ji?
Yes, sir. Can you hear me? I'm not on the.
Yeah, we
Hello.
can hear you, Rajora.
Yeah. So I would like to thank everyone, all panelists. A great discussion, and we have learned so many things on economy and on the capital market. And I would, on behalf of ASSOCHAM, convey my grateful thanks to all of you. And any question, any suggestions on that can be sent to ASSOCHAM. We will certainly take up with concerned authorities and also be in touch with you and look forward to all your suggestions. And I wish each and everyone good health and stay safe. Thank you so much.
Thank you, sir. Thank you.
Thank you.
Thank you. Thank you, everyone.
Thank you.
Thank you, Vadhva ji. Thank you, Subhash ji.
Vadhva, everyone.
Thank you very much,
Thank you all.
Agarwal sir. Thank you very much. Thank you, Madam.